Deflation is a central banker's worst nightmare. And there's several reasons for this. The obvious one is that it increases the real value of debt. In deflation, it's funny. If you have cash, people hate cash because there's no yield. In deflation, cash can be your best performing asset because even though the nominal return is quite low, the real return can be quite high. If you have deflation of 2% and your money just stays constant, your money's worth 2% more because that's what deflation, prices go down, so your money goes further. So it's worth more. In a world of 2% deflation, the real return on your cash is +2, even if the banks pay you 0, because it's worth 2% more. It helps creditors, but it hurts debtors. But who's the world's biggest debtor? It's the United States government. The real value of the U.S. debt, $31 trillion, would go up in a deflationary environment, and they don't want that. That's one reason. But the real reason, the more powerful reason, this is what keeps them up at night, they can't stop it. See, with inflation, the Fed has always been confident. You get inflation, okay, they don't want it, but it happens. But when it does, we can crush it with high interest rates. And that's what Volcker did, and that's what Jay Powell's doing right now. But when you get deflation, they don't have any tools. Now, they'll do QE. The QE is a joke. How does QE actually work? Well, the way it works is it's money printing of a kind. So the Fed buys bonds from dealers, from the primary dealers, by treasury notes or bills, et cetera. They call up, they get an offer, they say, done. The Goldman or Citi, whoever it is, sends the treasury notes to the Fed, and the Fed pays for it with cash that comes out of thin air. What do the banks do with the cash? They give it back to the Fed as excess reserves. So that money doesn't go anywhere. You're inflating two sets of balance sheets, the bank and the Fed. The money doesn't get loaned out. It doesn't get spent. It doesn't increase velocity. It doesn't create jobs. The money doesn't go anywhere. It just sits on the Fed's balance sheet. So you can do it. They did do it. They increased their excess reserves to $9 trillion back in the pandemic, back in 2020, but didn't do any good. The other thing they can do is take interest rates to zero, and they will. This is the famous pivot. Wall Street correctly anticipates the pivot in ways that the Fed does not. But where Wall Street gets it wrong is they think the pivot's a good thing in the sense of, oh, the Fed's going to over-tighten and inflation's going to come down, and they're going to realize it and pivot to interest rate cuts, and so that's a soft landing and buy tech stocks. That's kind of how Wall Street thinks about it, very kind of one, not even two-dimensional. The reality is the Fed is blundering. They are raising rates. Inflation is going to come down. They are going to have to cut rates. They'll be the last to know, but they'll be cutting rates for a very bad reason, which is we'll be in a severe recession. Stocks will be down 30%. So the idea that you're going to have a Goldilocks ending or soft landing is not true. The Fed will pivot, but they'll pivot too late. The damage will be done, and the damage to the economy, as they say, will be severe. Getting back to deflation, they can lower rates to zero, and they will, but then they're stuck. There's no evidence that negative interest rates are more easing, if you want to call it that. But everyday citizens in the United States, they look at that and they go, wait a second, why does the central bank have negative interest rates? They must be scared to death of deflation. And if they are, I'm going to save my money. I'm not going to spend it. Because first of all, the money will be more valuable, as I described. It also means there's a really bad economic outcome on the horizon, which is exactly when you would want to spend less, save more, build up cash reserves. So the idea of lowering interest rates into negative territory is, hey, you better go out and spend it because, you're going to lose it if you keep it in the bank. But people do the opposite. They hoard it. It actually is worth more in real terms, as I described. So you get the opposite of what they think. But again, the economists lack common sense. So negative interest rates don't work. QE doesn't work. Nothing works. You can't get out of deflation. There's only one way out. And by the way, everything I'm describing actually took place between 1929 and 1933 during the worst stage of the Great Depression. FDR was sworn in. The first thing he did, like on the first day or second day, by executive order, he closed every bank in America, every bank in the United States. Can you imagine a president getting on TV today and saying, my fellow citizens, as of now, all the banks are closed, all of them. We'll get back to you when they reopen. His other problem was deflation. And the way FDR broke the back of deflation, and we had very good growth in 33, 34, and 35, he devalued the dollar against gold. And he raised the price of gold 75% from $20 an ounce to $35 an ounce. And it wasn't to enrich holders of gold. In fact, he confiscated all the gold first and then devalued the dollar. So it was like an inside trade. He had all the gold, so took the profits for the United States Treasury instead of U.S. citizens. But that aside, he didn't do it to reward holders of gold. He did it to break the back of a deflationary psychology. What he wanted and what he got, if the price of gold went up, which it did, the price of corn, wheat, steel, energy, everything else went up. And he turned the deflation around, turned it into inflation. 1933 was a great year for the stock market. So was 1934. We had good growth. Unemployment came down. Stocks rallied. And then the Fed, right on cue, screwed it up again in 1937 with premature monetary tightening. We went into a second severe recession in the middle of the Great Depression. But getting back to the point, what can a central bank do about deflation? The answer is nothing. But a government, a treasury, and a White House can devalue the dollar. Now, it doesn't do any good to devalue against euros or yen or, the Chinese yuan or any other currency, because that's a race to the bottom. What my first book, Currency Wars, was about. I devalue, then you devalue, then I devalue some more, and you devalue some more. We never get any further ahead. In fact, it's a negative-sum game. But gold is different. Gold can't push back. If you devalue against gold, gold just sits there. It can't devalue. It's not a currency. There's no central bank of gold. So it's perfect for that. The problem today, of course, is that we're not on a gold standard. You can't break a peg that doesn't exist. So you don't even have the FDR toolkit from 1933. So deflation is one of the most serious economic problems you can have. It keeps the central bankers up at night because they know they can't do anything about it. And you can't even play the gold card because you don't have a gold standard. You don't have a gold peg. So it's a very, very serious problem.
So touching on gold there for a minute, because I know you've been a big proponent of gold, you highlight that inflation, even at its average rate of around 3%, cuts a dollar in half in about 23 years. So if we start to see disinflation or deflation, and we just get down to like a 5 or 6% range, for a prolonged period perhaps, how does an investor best protect themselves, whether it's gold or maybe some other assets?
Let's just take 6% inflation. It's pretty high. 6% inflation cuts the value of the dollar in half in 12 years. Okay. 12 more years, it's half again. So from birth to the age of 36, which is just kind of your early mid-career, whatever, the value of your dollar has been cut by 84%. That's with 6% inflation. Of course, higher rates of inflation is even faster, but even 2% inflation cuts it in half in 35 years, half again in 35 years. Average lifetime to the age of 70, your purchasing power has been cut by 75%. That's with 2% inflation, not that high. Why central banks think that's the target rate, I have no idea. The way I've described it is, it's like a little kid who sees a lot of money in his mother's purse, and it's like $50. If I steal the $50, I'll get caught. But if I take $2, nobody will notice. So I'll just take the 2. So the Fed figures a very low rate of inflation over a long enough period of time, diminishes the value of the dollar, and helps to pay off the national debt. And that is what we did from World War II until 1980. The debt to GDP ratio went from 120% to 30% when Ronald Reagan was sworn in, but it's been going up ever since. So that's why the Fed likes a little bit of inflation, but not enough to notice, I would put it that way. But the danger is in trying to get there, they go too far because they don't really know what they're doing. They do in theory, but their models don't work. And they actually end up in this deflationary trap that we talked about. Now, where does gold come in? Gold holds its value. It doesn't mean I know a lot of people invest in gold. I talk about gold all the time, and they're like, particularly the Austrians, they're banging the table. We have to go back to a gold standard, get away from fractional reserve banking. Let's have a gold standard. I said, well, be careful what you wish for, because if you have a gold standard, you're not going to make any money. If gold will be pegged, and that'll be that. You might as well, go to sleep. It's only in a world without a gold standard, where you have blundering central bankers, that the price of gold goes up a lot, and it preserves wealth. Gold's been going sideways for a few years at an interim peak of $2,039 an ounce in March 2021. So a little over a year ago, about a year and a half. But in 1999, it was $200 an ounce. And today, if it's $1,800, okay, it's not 2,000, but $1,800, that's still 9 times your money in about 23 years. So it does its job, but certainly in inflation, we've been talking about inflation, deflation, and the tug of war. We have inflation for the short run. We're going to have disinflation, borderline deflation early in 2023 because we're going to have a very severe recession. But if the Fed decides to print money to get out of the recession, then the inflation may come roaring back again. So it's like a pendulum, but gold will serve you very well through those cycles. The one thing I can say to our viewers is that this is not over. There's been a little bit of a sigh of relief. Stock market rallied a little bit toward the beginning of April. And okay, that's a normal reaction. But any thought that the problem's been solved, the bailout's complete, you're not going to hear more, is just not true. There's more coming. Get ready for it. I can't tell you. I'm not going to, pick a specific name. And we all know the names of the big banks that might be in distress. I'm just saying that there are more dominoes waiting to fall. The really interesting part about this, and again, we can come back to the specifics, is that the dominoes falling is a good metaphor. It's, if you got 100 dominoes, you knock the first one, they're all going to fall. That's just physics. So how do you stop that? How do you stop that crisis? Well, you truncate, you drop a steel wall between 2 dominoes, and this one hits the wall and this one's still standing. But that's the bailout. The problem is each crisis tends to get bigger than the one before, which means each bailout gets bigger than the one before. My question, we now at the point where the needed bailout is bigger than the capacity of the central banks, that they've pulled all the rabbits out of a hat, played all their cards. And again, this goes back to what I did say about the Silicon Valley Bank rescue. It is the biggest bailout in history, and I can explain why. But if that's the case, and what else do they have? And then, so now we're dangerously close to the point where as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. The crisis is the dollar itself, and the euro, goes along with that. And then that's the crisis. And there's no way to bail out a dollar crisis with dollars, because you're just pumping more of what people have lost confidence in. And then, then where do you go? And there are good answers to that. We've seen it, again, we've seen it all before, but you have to kind of take the timeline out to, 1,000 years, or, the 1350s with the failure of the Bardi and Peruzzi banks in Florence, to see how these things can really play out. So this is big. It's not over. The regulators will attempt more bailouts, but we're at the point where I think you can start to question the regulators themselves. The Latin American debt crisis, broadly defined in the early 1980s, that played out. The intense phase lasted about 3 years, 82, 83, 84. It wasn't until 1990 that we got around to Brady bonds, which were the ultimate refinancing technique. But the intense period lasted about 3 years. Come forward to 1998, long-term capital management. That was about 3 months. That was July, August, September 1998. SVB was 3 days or less. It was like Wednesday, Thursday, Friday, and done. And I talked to a guy, no reason to mention names, but runs one of the largest endowments in the world. And he said, Jim, we were moving $8 billion out of Silicon Valley Bank, but we didn't know, because you get to close business Thursday. We didn't know until Sunday that the money was going to move. We got a confirmation on Monday. We did end up moving the money. But there was about a 48-hour period there from Friday to Sunday when no one knew. The wires had been completed. The recipients didn't have them. It was just in limbo. And it worked out. One of the big crypto promoters, back when one of the stable coins, actually it's USDC, had $3 billion in Silicon Valley Bank. And they talked about, all these small entrepreneurs and startups, they got 100 employees and $5 million in working capital, and that money's gone and they're all going to fail. There was something to that. But the fact is, you had Roku, Cisco, eBay. I mean, there were huge companies with multi-billion-dollar deposits in that bank. It wasn't all a bunch of little guys. And what Peter Thiel did, and he was right. I mean, I'm not criticizing him. He got his own money out, but he sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now. And a lot of people did, and that was that $40 billion. So, and I'm not sure if everyone knows the sequence, but on Friday night, March 10th, the FDIC took over Silicon Valley Bank. And they issued a press release. And they said, here's what we're doing. We're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured. No worries. You'll have your money Monday morning. And over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. And it's a receivership certificate. And they said, hang on to them. We're going to sell assets. And as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years, and they were very efficient. I worked with them at the time, and that was it. Well, that's when I call the billionaire crybabies came out and forced, Bill Ackman, all these guys. Oh, you got to save us, I'm like, well, you got to trade on Bill. $5 billion's not enough. But anyway, they pounded on the White House all weekend. Now here's something that very few people, almost nobody knew at the time, except the management, although they seemed to be asleep at the switch. 97% of the deposits of Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're like, 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's a way, if you're looking at these big banks or any institution or your own savings institution, to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at, battery technology, chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years, but they're working on it. Wind turbines, other sustainable fuel alternatives, et cetera. Again, I'm not for that if you like, if that's your field of research, but so much as is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were, by and large. And so the White House is getting hammered, not only because of entrepreneurs' job losses. And by the way, we are in an election cycle here in the United States, but from the greenies, who are extremely powerful. So that was Friday night. So Saturday, everyone's crying to the White House. Sunday night is 6 o'clock. By the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. The 6 p.m. Sunday, March 12th, they came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse. And then the week after that was something else. They always announce the collapse on Friday and they announce the relief on Sunday. So they have the weekend to work on it. So on 6 o'clock on Sunday, March 12th, 48 hours after the FDIC announcement, the government said, just kidding, the deposits are fine. They did a complete 180 under pressure from the Fed, the White House, et cetera. Even though FDIC did the right thing, legally, they said all the deposits are good, all of them. And then Jay Powell said to every member bank, not Silicon Valley, but every member of the Federal Reserve System, if you have underwater bonds, U.S. government securities, treasuries or certain mortgages, you can ship them to us. We will give you a loan at par value. We'll give you cash equal to par value, even though the loans are only worth 80 to 85 cents on the dollar, because interest rates have been going up for over a year. The value of the bonds goes down. That's bond math 101. Rates up, bonds down, prices down, rates go down, the prices go up. Well, the rates have been going up, so the prices are down. Here's the Fed saying, we'll give you 100 cents on the dollar for your 85-cent bond on a one-year loan. So the loan was important because it means they didn't actually sell them. It was collateral for a loan, except you're under collateralized. And the Fed's like, okay. The banks are kind of saying, oh, that's good. That's a good deal. I'll take it. I'll do that myself. Here's something under collateralized. You give me the cash on a 1-year low interest rate loan. And now in theory, I've got all the cash I need to, pay depositors if they're taking the money out. But better yet, I don't have to record the loss. By the way, those unrealized losses estimate probably $800 billion in the banking system as a whole. So here's the Fed saying, we'll give you, 100 cents on the dollar, even though your bonds are worth 80. And you don't have to take the loss because it's structured as a loan, not a sale. So this is a multi-trillion-dollar bailout. It's legal in the barest sense, but it's an accounting game. It's a bailout game of unprecedented magnitude. I think your use of the word global is very much on point, because it's often the case that, you look around the world, you've got the United States or, North America, if you want to throw in Canada, you've got the EU, you've got China, you've got Japan, they're all important economies, but they can kind of be in different parts of the business cycle. And it's not unusual for one part to be in recession, but another part of the world is like doing better. So then they use the phrase locomotive theory. The locomotive is going to pull us all out of the ditch, and we'll get going. So it's not unusual to have recessions in the United States or Europe or particular countries in Europe or Japan. I mean, Japan's had 9 recessions since 1989. I consider that one long 30-year depression. That's a debate for another day, but that's how I would describe Japan. But usually, one's not doing so well and another part of the world's doing better. That's not the case. What is happening right now, I see it, but there's an awful lot of data to back it up, is that we are going into, or may already be in, a global recession. Now, that's rare. It's rare when, China, Japan, U.S., Germany, they're all in recession at the same time. But that's what's unfolding. That's a big deal, well, for obvious reasons, because it affects basically everyone. But it's not like China's going to pull us all out of it with cheap exports, or Japan's going to put the pedal to the metal in terms of fixed asset investment, et cetera. So that's a really bad sign. I mean, and just to be very specific, we just saw U.S. fourth quarter GDP grew at a 2.9% annualized rate. People are like, yeah, that's pretty good. And, it's not good by post-1980 standards. It's not good at all by post-World War II standards, but post-2008, yeah, that's not bad. Again, you have to disaggregate it, and you look at what grew. It was inventories were a big contributor, and net exports were a big contributor. Fixed asset investment in particular, there was a big load of aircraft orders for Boeing, which is notoriously lumpy. They'll have a big month, blowout month, and then nothing for a couple of months, not nothing, but something very low. So when you look at that, inventories are counted as part of GDP, of course, but it's not necessarily a good thing. If inventories are piling up, it means retailers are not buying. The stuff's arriving, and this kind of goes back to the whole supply chain breakdown of a year ago. So you go back to, let's say, the spring of 2022. The supply chain had completely fallen apart. And if you were a purchasing manager and you were saying to yourself, okay, we're kind of coming out of COVID, we're going to start growing, but the supply chain is broken. So instead of ordering one, container, I'm going to order 3 containers because maybe one will get through, through the bottlenecks. I only want one, but I'm going to order 3 and hope for the best. What happened was a lot of the stuff was alleviated, not for good reasons, not really for logistical reasons, but because the consumers slowed down a lot beginning in June, partly in reaction to the Fed starting to hike rates in March of 2022. And then here come the 3 containers. The exact moment when demand destruction is kicking in, your inventory is going to the rafters. So what do retailers do, or wholesalers for that matter, but retailers, they slash prices, that 2-for-1 sales, because inventories are a nightmare for retailers for obvious reasons. Number one, you have to finance them, so they eat up working capital. It could be cash, but you got a bunch of stuff in the back office. And number two, it just takes up space. I mean, insurance costs and other costs like that. But the other thing people kind of underestimate is that, like fashion, stuff goes out of fashion. Last spring's styles are not next spring's styles. You still got last spring stuff. Good luck. We're getting close to spring. So dumping that stuff, consumer electronics, you got an iPhone 13. Well, everybody wants an iPhone 14, whatever. I mean, you take the point. So piling up inventories is a very unhealthy sign. It means the retail sector is drying up, demand destruction is kicking in, costs are going up because you got to finance all this stuff, and your profit margins are going down. So I don't take a lot of comfort from that. But the other thing, to the extent you can disaggregate monthly data, and there's a lot of monthly data, 2.9% annualized for the quarter, but it really slowed down in December. So it's sort of a waning type of thing. Christmas was a disaster. I mean, people bought stuff for Christmas, but way below expectations. And again, it goes back to piling up the inventory at the worst possible time. So it looks like the U.S. is going into 2023. Possibly recession started in December. If not, we expect it to start soon. But you're seeing the same thing in Europe now. Europe got a break with the weather. Obviously there's a war going on, so that's a big factor. But and natural gas prices skyrocketed, and oil prices skyrocketed again in mid 2022. They've come down, and people expected them, and I'm going to include myself, to go up again because of the winter. But the winter turned out to be pretty mild. I saw pictures of, people like kayaking around Copenhagen, it was like in t-shirts, So that was a break. That's, act of God, but it works. So they got a little bit of a break, but it doesn't mean that, all is well or they're out of the woods. And there are other things going on. China is a best case. They went from zero COVID, which was, it was bad public policy and bad health policy, but they did it anyway, maybe for political reasons, because Xi was trying to get through the National Party Congress in October. But he did, and he's emperor for life, the new Emperor Xi. So they flipped almost on a dime. Now, there were riots beginning November 24th, 2022, pretty bad ones. People raged through cities. They tore down all these testing tents. They knocked down barricades. They hung banners. And the leadership in Beijing, they're looking at this thinking Tiananmen Square, 1989. So they just turned on a dime and said, okay, let it rip. The positive, let it rip. Okay, let everyone get infected, and we'll do the best we can. But one of the ways you get through it is by letting it rip, and you develop what's called herd immunity. And that's what worked in North America and Europe. And so China decided to let it rip. But when you look at the numbers, you're like, okay, you have 1.4 billion people. So you take a modest infection rate, meaning, like 30%, let's say, you're talking, round number, 450 million infections. And if you assume a modest mortality rate, 1/4 of 1%, and that's borne out by the data, you're looking at close to 2 million dead. But the other difference between China and Europe and the US is that they don't have the healthcare system to deal with it. Our healthcare system, which is pretty good, was strained. Same thing in Europe. China has nowhere near the ICU units, the oxygen, the treatments, the professionals, the nurses and doctors, not even close. And when you get out to the village level, which is where most of the people still live, believe it or not, they often have nothing. It actually is an interesting supply chain twist there, because the Chinese were more or less told, you have to self-medicate. We don't have the hospital beds for you. So they went out and stripped the shelves of ibuprofen, Tamiflu, Motrin, Klopin, whatever they could get. And Beijing actually said, go back to TCM. Like, what's TCM? It's like traditional Chinese medicine, herbs and teas and things like that. Well, I'm not knocking it, by the way. Some of that stuff's pretty healthy, but they're at a primitive level. They're like kind of at a Bronze Age level. But that is hurting the economy as much as the zero COVID. They had no good ways out. I'm not saying one's better than the other. They're both awful, but you still have a lot of things that are not COVID. The real estate collapse, excessive debt, the demographic decline, just the impact of top-down management where you can't possibly get everything right, and decoupling from the U.S. and the U.S. cutting off, high-tech exports to China, including third country exports where they're relying on U.S. licenses or equipment. So China's in a deep hole, probably in a recession. Japan, same thing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession based on a lot of factors, some of which we've spoken about. Now, that doesn't
especially if it's a recession, because they're not going to want to make loans with that money. They'd rather buy treasuries that are perceived to be safe. Probably.
Correct, especially with positive carry and lever at 10 to 1 under Basel, you can make very good returns on equity. So you do have a large pool of intermediate buyers before you get to the Fed. It doesn't really solve the problem. It just passes it around the banking system. By the way, the Chinese are doing something very similar right now. Everyone's like, why hasn't the People's Bank of China sold more dollars? Well, it's because they're making the banks do it. The commercial banks are selling the dollars and propping up the yuan. And we could see something similar in the United States. So that's one. I just kind of pencil in the commercial banking system, at least the big banks, as potential buyers of not quite last resort, as a way to put it. But the other thing, the BRICS, what they've done, this is part of the brilliance, they've opted out of the exchange market. They're like, because normally if the dollar is getting weaker, you're getting stronger. That's bad for exports. It's bad for export-related jobs, et cetera. And it's currency wars. That was my first book, Currency Wars. But by defining their currency by weight of gold, not dollar amount, but by weight of gold, they're out of the foreign exchange market. Yeah, so and they can just sit back and watch the show.
Yeah. The other potential buyer, and this is what, another self-serving conclusion, is public pensions, because they're so underfunded. And if the federal government actually has to backstop them, they may say, look, from now on, you have to hold X% of your assets in treasury bonds or something like that, and create a natural buyer for the paper. But
no, it's a good point, Steph. There are some pools of capital out there that can support the bond market, but then there's an opportunity cost. Like, what else could they be doing? Infrastructure, other kinds of investment, startups. I mean, there are other things to do with the money.
The BRICS. Hello.
Yeah, exactly. Right.
I mean, that's going to be very interesting to see how that all unfolds.
Yeah.
So, yeah. Well, this has been tremendous. Are there any things that you think were left on the cutting room floor here that you want to go back to and dig into? Oh, actually, I have one last question for you. Yep. And maybe this would be one of those questions. Does the election in 2024 here in any way impact your thinking about the outlook for the dollar? I know it's hard to get into that without getting super political, but when I think about the BRICS trying to create a an alternative to sort of the Western infrastructure and financial setup, et cetera. It just seems like not, I don't know if oblivious is the word, but sort of benign neglect that the US isn't taking any of this seriously. Policymakers, like you described, really don't view this as a legitimate threat to the US hegemon status, much less the reserve currency status. So they're kind of just not paying attention to this, don't take it seriously. Do you think that that will change in Washington, and would the election in any way shift the urgency on policymakers here to be a little more serious?
Yes and no. I was going to say mostly no, but let me talk about the election for a minute. And I people think I'm a political junkie. I do follow it closely, but I kind of, part of me doesn't care. I'm like, it's a mess. But I gave a presentation to a big audience the other day, and it was an end of thing panel, and they said, what are we missing, or what's going to happen? I said, here's the thing. What have we learned? I said, well, we haven't learned about uncertainty because we already know about uncertainty. We all understand that we're living in an uncertain world and we have to make allowance for that. So we didn't learn that. We already knew that. I said, well, what is new is the tempo of shocks is accelerating. There are shocks, go back to the panic of 1837 or 1857 or 1898. You know all of them. I've lived through enough of them. I'm kind of a magnet for trouble. But there's no end to financial panics. But what's different about this is that we may be looking at a tempo that's a lot faster. It's not every 7 years or every 10 years anymore. Between the U.S. is losing the war in Ukraine badly. You might even see Poland come in and bite off the western half of Ukraine, what former Ukraine, up to Lviv, and Russia take the bottom 1/3, including the entire coastline through Odessa, and leave a little landlocked rump state around Kiev, maybe. So and there's no way to cover this stuff up. The New York Times and the Washington Post, I read them the same way I read Pravda during the Cold War. It's all lies, but they're valuable lies because it's good to know what the other guy's lying about.
Exactly.
If he's lying, it's like you must have a reason for that. It must be important to you. So there's intelligence value in lies, and that's why I read the Times and the Post. But I teach a seminar on financial warfare at the U.S. Army War College, very select group, about 12 people in the class, seminar style, mid-career, 40-ish, lieutenant colonels, Navy commanders, that level. But they've been handpicked as the future big brains. These are people who in 7 or 8 years are expected to be, 3-star generals, national security advisors, et cetera. And I do the financial warfare module. And I told them this. I said, when I taught the class in 2022, I said, the sanctions are going to fail. Russia's behavior will not be altered. Russia's military will not be diminished, and they will backfire on the United States. And they got a lot of pushback because everyone's gung ho, Ukraine. This year, when the class was there, I said, here's what I taught last year's class. And I was right about everything. Everything I said was right. So that got their attention. And there was one lady, kind of quiet, but very nice lady. And she came up to me afterwards. Oh, because I made a big deal about sourcing. Because if you can't trust the New York Times, the Washington Post, or NBC, or any of that stuff, how do you find out what's going on? I mean, I'm not on the battlefield, I'm not even in London. And it was hard. I mean, I'm good at it, but that was hard. That took months to track down sources and websites and that you could rely on. It wasn't like the Russian Defense Ministry. And then, so this lady came up to me after the class and she said, Jim, could you give me your list of sources? I said, of course, I'll email it to you, no problem. But then I thought to myself, wow, you're kind of senior in the State Department. You have a top secret security clearance.
You're like, you should know all this, right?
Why are you asking me for sources?
Right.
I gladly gave it to her, but it shows how corrupt our government is that they're lying to themselves. That's the worst possible position to be in.
Or how it inbred that hubris is, this idea that we don't have to research this because it's never going to be a legitimate threat to the way we work right now. The status quo is going to remain the status quo forever.
Right. Yep.
It's just amazing. Oh my gosh. Well, this whole Russian thing has been, it looked like we really provoked it to some extent.
Yes.
At least had a role in, pushing Putin in there, presumably with the idea that it would inure to the US's benefit somehow. And it ends up not only being a disaster from a military standpoint, but because of the sanctions, now from a financial standpoint as well. So, I mean, if you were to invent the worst possible policy, you probably would have done everything that they did there, step by step.
That's right. Victoria Nuland won this war. By the way, she just got promoted yesterday. She's now Deputy Secretary of State. She replaced Wendy Sherman, who I don't always agree with Wendy, but she's smart. Victoria Nuland has now replaced Wendy Sherman as Deputy Secretary of State, second only to the Secretary of State. But she wanted this war, and she got it. There's an old proverb: "Be careful what you wish for; you may get it." And that's exactly what happened. By the way, quick footnote: Victoria Nuland is going to South Africa the week before the BRICS summit.
Interesting.
She's going to try to bully South Africa into like not doing the deal or joining Russian sanctions or anti-Russian sanctions. So it's going to fail. The mission is going to fail.
Yeah, talk about 2 decades late and several dollars short on that.
Correct.
Where have you been for the last 17 years? So,
it's the opposite of diplomacy. This is like schoolyard bully. And why was Janet Yellen in Beijing 3 weeks ago, eating magic mushrooms, according to some. The Fed will not be able to get interest rates to 5% without causing recession, not to mention the impact on the deficit and a lot of other things. So the Fed can't escape the room. So if inflation stays where it is, the Fed can't get interest rates to a real level without causing recession, which will sink the stock market. But even if inflation comes down a little bit, that'll be a sign of recession. So you're raising rates into a recession, which will cause a recession. You end up in a recession either way. It's just a question of whether the Fed persists or throws in the towel. Now, we've seen this movie before. What's going on is an exact replay of what happened between 2013 and 2019. May 2013, Bernanke announces the taper. Expectation is they're going to start the taper in September. He chickens out. They start the taper in November 2013. They finish the taper in November 2014. Then here comes Yellen. She's going to raise rates. Take out the word patient from the statement. She doesn't raise rates until December 2015. And then she doesn't raise them again until December 2016. They went a whole year between 2 25 basis point rate cuts. And then here comes Powell, and then boom, okay, 25 basis points, boom, 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 gets them up to 2.25, which is where they want it to be, and gets the balance sheet down to about $3.5 trillion. They want to get it down to about $2.5 trillion. But he's got rates about where he wants them. He's got the balance sheet on its way down, and he's normalizing. And what happens? The stock market crashes 20% between October 1st, 2018 and December 24th, 2018. That was the famous Christmas Eve massacre where the stock market fell 3% in one day. But the Fed's still tightening. The Fed tightened like a week before the Christmas Eve massacre. They tightened into the weakness. They were getting very close to crashing the stock market. They took it down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out. Okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE. I forget if it was 8 or 9, whatever. Lost track of QE. He starts QE 8, let's say. And then that takes you into 2020. And here comes the pandemic, and rates go down to 0. And the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen, and it's not clear which, but it's going to be one or the other. they're going to keep tightening and keep tightening, keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. But the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil. They don't build pipelines and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here. The supply chains are getting worse. But these supply chain disruptions didn't start with the war. They didn't even start with the pandemic. They started with Trump's trade war beginning in 2018. I found a very good book on that written by Lorianne LaRocco. And what's interesting about her book is that she finished it in late 2019. So it's almost like a controlled experiment. It was pre-pandemic. It's easy to say that the pandemic disrupted the supply chain, which it did. And the war disrupted the supply chain, which it did. But here we have a very rigorous study of what was happening to supply chains before either one. And the answer is they were a mess. They were a mess back then because of tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That sounds easy because Brazil grows soybeans. Well, guess what? You got to get the ships to Brazilian ports. You got to rearrange all the logistics lanes. That was happening already. Pandemic made it worse, and now the war makes it even worse than that. Yeah, the world is breaking up. We're decoupling. Globalization is over. There'll be a new form of it. It's not the end of world trade, but you're going to see, maybe the Five Eyes, UK, US, Canada, Australia, New Zealand, and friends in Western Europe form a new trading bloc, but exclude China and Russia. It'll be a little bit more like the Cold War. I talked to Paul Volcker about this, but here's what happened in the 70s. Now, it started as cost push inflation. It was the Arab oil embargo in 1973, after the 1973 war, the Israel-Arab war. Then the Arabs threw the embargo on us. The price of oil quadrupled. It went from $3 a barrel to $12 a barrel. It sounds cheap, but that's a 300% increase. And then we had a severe stock market crash and recession in 1974, which at the time was the worst since the Great Depression. We've had worse ones since, but at the time, that was the worst recession since the Great Depression. Then we come out of that, and along comes the Fed, and we went off the gold standard. Nixon had an easy monetary policy in 72. It was a little earlier for his reelection effort, et cetera. So here comes the inflation. But what happened along the way, and then you had another Arab oil, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were double oil shocks. That was supply-driven cost push inflation. But along the way, it morphed into demand pull. It morphed into a demand-driven inflation. And I lived through it. I was a young up-and-coming lawyer at Citibank and a senior officer living in New York City. And that was the world where if you wanted anything, new furniture, TV set, vacation, whatever, you ran out, you dropped everything, ran out and did it because the price was going up so fast. So that's instructive in two ways. Number one, it shows that the Fed's always behind the curve. It shows that these things can persist a lot longer than people expect. But in my view, most importantly, because I think things are going to happen more quickly now, it shows inflation morphing from cost push to demand pull, morphing from something on the supply side to a psychological shift on the consumer side. And Volcker crushed it, but at a huge cost. Unemployment was about 11%. He took interest rates to 20%. How does that feel? Mortgagors and student loan holders and others, 20%. You're talking about 40% on credit cards in that world. And people forget, doesn't inflation, don't you have high growth or whatever, at least, or low unemployment? No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We had 3, 1974, 1980, and 1981, which lasted until 1982. And by the way, people lost confidence in the dollar. In the late 70s, Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now, it was Treasury debt. You had the Treasury credit, but it was denominated in Swiss francs because nobody wanted dollars. That's how bad things were. What's coming is a very severe recession. The monetary tightening on top of a world where growth is deaccelerating, inventories are sky high. The funny thing about the supply chain is you go back a year or so, kind of this time last year, we all remember headline, supply chain's broken down, the shelves are bare. So all true. That was happening at the time, and that's when I started working on the book. But what a lot of purchasing managers did, and inventory managers, they doubled their orders. They said, well, or tripled the orders. They said, well, if the supply chain's breaking down and I want just a normal amount, I better order 3 times as much or twice as much just to get what I want. And they did. Well, what happened was by the summer, some of that pressure had been alleviated. And here come the shipments into the warehouses that are twice as much or 3 times as much as what you needed at the exact same time that the Fed was destroying demand. And so demand drops off a cliff. Retail sales drop off a cliff. The warehouses go from being empty to being full to the rafters. And now all that merchandise is sitting there. So, Nike, just many examples. So what do you do when you're in charge of inventory? You cut prices. You don't want that inventory. It costs a lot of money to keep it in the warehouses, number one. Number two, a lot of it's seasonal. It's like, who wants to buy, a summer dress in December? Not too many people. So they just slash prices, and that reduces margins and reduces profits. So we're just kind of flying into the face of all that, with the Fed tightening rates into weakness. The Fed will be the last to know because they're very model driven and the models are badly flawed, mostly with the Phillips curve and their focus on the unemployment rate, which is not a good measure of what's going on in the labor force. So we're flying into a really bad recession. The stock market's starting to get the message, but you've got this pivot narrative. You can't quite get rid of that. Some of the buy the dips people are still around, so count on them to buy into what could be a horrendous bear market. You got your buy and hold crowd. Remember in 2001, the Nasdaq dropped 80%. And a lot of people got out, but they said, well, just hold on to it. Well, it did come back, but it took until 2015. That's a long time. A lot of people died in the meantime. You're waiting 14 years to get back to where you were. So those people are still around, but there is what I call the pivot crowd. So the Fed pivot is a narrative, and it kind of goes like this. Yeah, the Fed's tightening. We see that. Inflation is going to come down really fast. The economy is going to slow down really fast. Both of those things are happening. Inflation, a little less so, but the economic slowdown is there. And the Fed's going to get the wake-up call and have to cut rates. And cutting rates, that's the pivot. They're going to pivot from rate hikes to rate cuts. And that's good for tech stocks, so buy stocks. Now, that's the narrative. It prevailed in late July and most of August. The stock market did go up. There was a decent rally in the middle of what's become a bear market based on this Fed narrative that they were going to have to cut rates. There are 2 huge fallacies in that narrative. The first one is who says the Fed's going to get the message? And if you look at what Jay Powell said and what he repeated, we're going to raise rates. We're going to crush inflation. I've been following this for 50 years. I've never seen a Fed chairman use the word pain 3 times in one paragraph, but he did, and he meant it. He knows there's going to be a recession. They're causing it in part. Unemployment's going to go up. He said that. He tied unemployment to killing, basically demand destruction and getting inflation under control. He said, that's how we're going to do it. And you're already starting to see some early signs of that. So with that as their focus, who says the Fed's going to, get a wake-up call? Almost certainly not. I mean, they told us what they're going to do. They're going to raise rates. And then he said, if we see progress on inflation, we'll pause. But pause doesn't mean cut. It means just wait a long time, because at that point, core PCE, that's personal consumption expenditure, core, which excludes oil and food, and that's just how they do it. That's their favorite metric. You can debate whether it's the best one, but the debate doesn't matter because that is the one they use. Let's say that comes down to around 3.5. Okay, it's still not 2. Now, what Powell, which is their target, so what Powell said is, we don't have to keep raising rates to force it to 2. We just have to raise them enough that it'll get to 2 on its own. That's what they call restrictive policy. So, but that's not a rate cut. He said that might last for a year, all the way into 2024. That's when he was talking about rate cuts. Now, again, this can change, but they've told us what they're going to do. I always say forecasting the Fed's the easiest thing I do because they actually tell you what you're going to do, what they're going to do. You just have to listen and believe them. Now, the hard part is understanding how badly they're going to destroy the economy and when they're going to get the wake-up call. That's the hard part of the analysis. But telling what they're going to do is the easy part because they kind of tell you. So the stock market notion that somehow they'll be cutting rates is just false. But the second fallacy is even bigger: is tell me why it's a buy signal for stocks if the Fed is throwing the economy into such a bad recession that unemployment is going to go up significantly and growth is going to come down, inflation is going to come down. Why is that a buy signal for stocks? Maybe at the bottom, and the bottom might not be till late 2023. Okay. Yeah, there are opportunities to buy the bottom, but we'll be nowhere near the bottom. Bear market rallies are really interesting. Some of the biggest rallies in history have been in the middle of bear markets where you ended up losing everything, but for a couple of days or weeks even, it's, hey, the bottom's in, and you buy stocks, et cetera. So you have to watch out for that. So my expectation is the recession's coming. It's going to be really bad. Inflation is going to come down fast, but not quite fast enough for the Fed. They're going to keep raising rates, destroying demand, raising unemployment. And we're going to wake up with a severe recession, high unemployment, and a much lower stock market. I was around for the 2008 financial crisis. I was around for 1998 financial crisis. I negotiated that bailout for LTCM. 98 was interesting because it was an acute financial crisis that came very close, within hours, actually. And I was in the room with the Treasury and Italian finance ministry and 19 banks and, a thundering herd of lawyers trying to save the world. But we came within hours of shutting every market in the world. There was a $4 billion all cash. You couldn't use the word due diligence because there wasn't time. It was just, hey, the Fed wants us to do this, so let's just do it. So that worked, but it was a very close call. They would have shut down Tokyo and then around the world, London and finally New York. And they would have opened days later, but that's how with trillions of dollars of losses, it would have been worse than what actually happened in 2008. It didn't happen. But there was no economic recession at the time. That confuses a lot of people because, and particularly if you're using 2008 as a frame of reference, there are financial panics and financial crises and liquidity crises, and there are recessions, some of which are severe. But they're two different things. 98 was an acute financial crisis with no recession. 2000 was a mild recession, but there was no severe financial crisis. Now, NASDAQ collapsed, but there wasn't a lot of leverage in NASDAQ. There was no contagion there, but it didn't spread because no banks failed, no major brokerages failed, et cetera. So in 1990, a mild recession, but no financial panic. October 1987, interesting, stock market fell 22% in one day. Not a week or a month, but one day, down 22%. And that was a financial crisis, but there was no recession. So they're separate things. However, they can happen together. And 2008 was an example. There we had both. But I would encourage analysts to separate those two things. Again, they came together. It was horrific, but they can happen separately. My point is, we may have a very bad recession, possibly worse than 2008. But 2008 is a model, and that may be what we're heading for, bearing in mind that these are two separate vectors. What's coming is a very severe recession. The monetary tightening on top of a world where growth is deaccelerating, inventories are sky high. The funny thing about the supply chain is you go back a year or so, kind of this time last year, we all remember headline, supply chain's broken down, the shelves are bare. So all true. That was happening at the time. And that's when I started working on the book. But what a lot of purchasing managers did, and inventory managers, they doubled their orders. They said, or tripled the orders. They said, if the supply chain's breaking down and I want just a normal amount, I better order 3 times as much or twice as much just to get what I want. And they did. Well, what happened was by the summer, some of that pressure had been alleviated. And here come the shipments into the warehouses that are twice as much or 3 times as much as what you needed at the exact same time that the Fed was destroying demand. And so demand drops off a cliff. Retail sales drop off a cliff. The warehouses go from being empty to being full to the rafters. And now all that merchandise is sitting there. So, Nike, I mean, just many examples. So what do you do when you're in charge of inventory? You cut prices. You don't want that inventory. It costs a lot of money to keep it in the warehouses, number one. Number two, a lot of it's seasonal. It's like, who wants to buy, a summer dress in December? Not too many people. So they just slash prices, and that reduces margins and reduces profits. So we're just kind of flying into the face of all that. With the Fed tightening rates into weakness, the Fed will be the last to know because they're very model driven and the models are badly flawed, mostly with the Phillips curve, and they're focused on the unemployment rate, which is not a good measure of what's going on in the labor force. So we're flying into a really bad recession. The stock market's starting to get the message, but you've got this pivot narrative. You can't quite get rid of it. Some of the buy the dips people are still around, so count on them to, buy into what could be a horrendous bear market. You got your buy and hold crowd. Remember in 2001, the NASDAQ dropped 80%. And a lot of people got out, but they said, well, just hold on to it. Well, it did come back, but it took until 2015. I mean, that's a long time. A lot of people died in the meantime. You're waiting 14 years to get back to where you were. So those people are still around, but there is what I call the pivot crowd. So the Fed pivot is a narrative, and it kind of goes like this. Yeah, the Fed's tightening. We see that. Inflation is going to come down really fast. The economy is going to slow down really fast. Both of those things are happening. Inflation, a little less so, but the economic slowdown is there. And the Fed's going to get the wake-up call and have to cut rates. And cutting rates, that's the pivot. They're going to pivot from rate hikes to rate cuts. And that's good for tech stocks, so buy stocks. Now, that's the narrative. It prevailed in late July and most of August. The stock market did go up. There was a decent rally in the middle of what's become a bear market based on this Fed narrative that they were going to have to cut rates. There are two huge fallacies in that narrative. The first one is who says the Fed's going to get the message? And if you look at what Jay Powell said and what he repeated, we're going to raise rates. We're going to crush inflation. I've been following this for 50 years. I've never seen a Fed chairman use the word pain 3 times in one paragraph, but he did. And he meant it. He knows there's going to be a recession. They're causing it in part. Unemployment's going to go up. He said that. He tied unemployment to killing, basically demand destruction and getting inflation under control. He said, that's how we're going to do it. And you're already starting to see some early signs of that. So with that as their focus, who says the Fed's going to, get a wake-up call? Almost certainly not. I mean, they told us what they're going to do. They're going to raise rates. And then he said, if we see progress on inflation, we'll pause. But pause doesn't mean cut. It means just wait a long time, because at that point, core PCE, that's personal consumption expenditure, core, which excludes oil and food, and that's just how they do it. That's their favorite metric. You can debate whether it's the best one, but the debate doesn't matter because that is the one they use. Let's say that comes down to around 3.5. Okay, it's still not 2. Now, what Powell, which is their target, so what Powell said is, we don't have to keep raising rates to force it to 2. We just have to raise them enough that it'll get to 2 on its own. That's what they call restrictive policy. So, but that's not a rate cut. He said that might last for a year, all the way into 2024. That's when he was talking about rate cuts. Now, again, this can change, but they've told us what they're going to do. I always say forecasting the Fed's the easiest thing I do, because they actually tell you what you're going to do, what they're going to do. You just have to listen and believe them. Now, the hard part is understanding how badly they're going to destroy the economy and when they're going to get the wake-up call. That's the hard part of the analysis. But telling you what they're going to do is the easy part, because they kind of tell you. So the stock market notion that somehow they'll be cutting rates is just false. But the second fallacy is even bigger, is tell me why it's a buy signal for stocks if the Fed is throwing the economy into such a bad recession that unemployment is going to go up significantly and growth is going to come down, inflation is going to come down. Why is that a buy signal for stocks? Maybe at the bottom, and the bottom might not be till late 2023. Okay. Yeah, there are opportunities to buy the bottom, but we'll be nowhere near the bottom. Bear market rallies are really interesting. Some of the biggest rallies in history have been in the middle of bear markets where you ended up losing everything, but for a couple of days or weeks even, it's, hey, the bottom's in, and you buy stocks, et cetera. So you have to watch out for that. So my expectation is the recession's coming. It's going to be really bad. Inflation is going to come down fast, but not quite fast enough for the Fed. They're going to keep raising rates, destroying demand, raising unemployment. And we're going to wake up with a severe recession, high unemployment, and a much lower stock market. I was around for the 2008 financial crisis. I was around for 1998 financial crisis. I negotiated that bailout for LTCM. 98 was interesting because it was an acute financial crisis that came very close, within hours, actually. And I was in the room with the Treasury and Italian finance ministry and 19 banks and, a thundering herd of lawyers trying to save the world. But we came within hours of shutting every market in the world. There was a $4 billion all cash, you couldn't use the word due diligence because there wasn't time. It was just, hey, the Fed wants us to do this, so let's just do it. So that worked. But it was a very close call. They would have shut down Tokyo and then around the world, London and finally New York. And they would have opened days later. But that's how, with trillions of dollars of losses, it would have been worse than what actually happened in 2008. It didn't happen, but there was no economic recession at the time. That confuses a lot of people because, and particularly if you're using 2008 as a frame of reference. There are financial panics and financial crises and liquidity crises, and there are recessions, some of which are severe. But they're two different things. 98 was an acute financial crisis with no recession. 2000 was a mild recession, but there was no severe financial crisis. Now, NASDAQ collapsed, but there wasn't a lot of leverage in NASDAQ. There was no contagion there, but it didn't spread because no banks failed, no major brokerages failed, et cetera. So in 1990, a mild recession, but no financial panic. October 1987, interesting, stock market fell 22% in one day. Not a week or a month, but one day, down 22%. And that was a financial crisis, but there was no recession. So they're separate things. However, they can happen together. And 2008 was an example. There we had both. But I would encourage analysts to separate those two things. Again, they came together. It was horrific, but they can happen separately. My point is, we may have a very bad recession, possibly worse than 2008. But 2008 is a model, and that may be what we're heading for, bearing in mind that these are two separate vectors.